Welcome to the deep dive. We're jumping straight into the Australian economy today because, well, just a few weeks back, things felt quite different, didn't they? There was this real moment of economic optimism brewing.
Yeah, you could almost feel it. A sense of relief, maybe.
Definitely. You remember the mood real wages? They were finally growing. Strongest rate in 5 years.
Yep.
The RBA had delivered a couple of rate cuts already. And the big one, inflation. It finally had a 2 in front of it.
That, too, felt significant. Like maybe, just maybe, the worst was over.
It really did. It felt like that long, hard slog against rising prices might actually be ending. Green shoots, you know.
But that feeling didn't last long.
Not at all. Lincoln, you missed it, really, because just 5 weeks later, the whole script is flipped.
Completely.
The new data landed, and inflation jumped. Accelerated, actually, to 3% in the year to August.
And that's a sharp rise from the 1.9% we saw in June.
Absolutely shattered that sense of relief people were starting to feel.
And that, for you, our listener, that's the core tension we need to get into today. That 3% figure. It puts inflation right at the very top edge of the Reserve Bank's target range.
The RBA's range being 2% to 3%.
Exactly. And the RBA, remember, that's the institution focused on getting stability back, on eventually easing pressure on, say, your mortgage.
And it's not just the number itself, is it? It's the direction.
That's the real kicker. It's moving up again, after we saw that steady downwards path from the peaks back in 2022.
So our mission today is to try and unpack this. What's going on? Is this, the inflation dragon really stirring again, or is it just a statistical bump, a one-off?
We need to look at the different takes on this bumpiness.
Okay, let's dive in. We have to start with how the analysts reacted, because some were genuinely quite shaken by this.
Yeah, the market reaction was pretty strong.
Jonathan McMenamin over at Barrenjoey, for instance, he called Wednesday's release one of the worst-case scenarios for the inflation data.
That's strong language from an analyst. You don't hear that every day.
No. It tells you they found something concerning deep down in the numbers.
And it wasn't just the headline 3%. The real worry comes from where the price hikes are happening.
Right. It's the details.
It's concentrated in the services sector, things that really reflect what's happening here at home, domestic demand, wage pressures.
Things like.
Well, the sources point to stubbornly strong price increases in everyday stuff. Hairdressing, eating out, takeaway food, household services.
Okay.
On top of that, construction costs seem to be coming back. And crucially, rent inflation has stopped slowing.
Rent inflation stopping its slowdown is a big one.
It really is. And these aren't problems from overseas shipping or global commodity prices anymore. These are homegrown issues, structural price pressures right here.
That's the key difference, isn't it? Goods inflation can sometimes sort itself out if global supply chains ease up.
Exactly, or if commodity prices fall. But services inflation, that's generated domestically.
It's about wages, local demand.
Precisely. It's a direct reflection of that. And that's why the RBA calls it sticky. It suggests those higher interest rates haven't quite cooled things down enough here at home. Consumer demand is still perhaps a bit too strong.
Which brings us to maybe the biggest and maybe the scariest conclusion from the analysts like McMenamin.
Yeah.
He suggested this data tells us the speed limit of the economy is lower than we thought.
Okay, explain that. What does speed limit mean here?
It means the economy can't grow very much or pick up much speed before it starts generating inflation again.
Right. So even a small uptick in activity is enough to overheat things.
That seems to be the implication. But wait, isn't that a bit strange? We hear all the time about households cutting back, feeling the pinch.
Yeah, the cost of living pressure is real.
So if spending is supposed to be weak, how are we hitting this inflationary wall so quickly?
That's the paradox, isn't it? It suggests that the moment people feel even slightly better off, maybe they book a flight or get some work done on the house or even just get a haircut, the economy immediately generates enough heat to push inflation up again. If that speed limit is truly lower, even that little bit of activity is too much for the current structure.
Wow, okay.
So it implies the RBA's job is much tougher. To stop this rebound, they might need to keep conditions feeling, constrained for longer than people hope.
Prolonged weakness needed for stability. That's why the analysts are worried.
Yeah, it's a sobering thought.
Okay, so that's the quite alarming view from the analysts. But the RBA itself, they're trained professionals. They don't panic easily.
No, they tend to take a longer view.
And they have a different perspective on that 3% number. They've pointed out the limitations of these monthly figures.
Right. They always caution that the monthly data can be volatile, jumpy, They prefer the quarterly picture.
And their main reason for staying relatively calm
Yeah.
seems to be the one-offs argument.
Ah, yes, the temporary factors.
The source material highlights that the headline figure is being buffeted by one-offs, the main one being that surge in electricity prices.
And it's crucial to understand why power prices jumped. It wasn't really new inflation in the system.
It was subsidies ending, right?
Exactly. It's a mechanical effect.
Yeah.
The government was helping pay part of your bill for a while. When that help stops, your bill suddenly looks much higher compared to last year's subsidized price.
Even if the underlying cost hasn't changed much in that instant.
Precisely. So that base effect, comparing to the subsidized period, makes the headline inflation number jump. It looks scarier than the underlying trend might actually be.
So the RBA kind of saw this coming. Maybe not the exact timing, but the effect.
Essentially, yes. Their chief economist, Sarah Hunter, she told a parliamentary committee recently that the RBA had already factored in the end of those subsidies, pushing headline inflation back towards 3%.
Okay.
Though perhaps they thought it might happen a bit later, maybe early 2026. But it confirms their view that these monthly figures can be, as she put it, unreliable for setting long-term policy.
Right. That gives us a much calmer perspective to balance against the analyst view. But, and this is the big but for you, the listener, regardless of why we hit 3% blip or dragon, it's already having real policy consequences. It's pushed back the timeline for interest rate relief.
Yes, that seems undeniable now.
And just to be crystal clear,
Yeah.
nobody we're seeing in the sources is seriously talking about a rate hike.
No, that doesn't seem to be on the table.
The whole conversation has shifted. It's now about how long rates stay at this current high level. And that duration just got longer.
Significantly longer. The speed at which expectations changed was quite something. Jonathan Kearns, he's chief economist at Challenger, used to be a senior official at the RBA.
Right.
He remarked on how striking it was, how quickly analysts flipped their calls on rate cuts.
So what was the old expectation? A cut maybe later this year.
The widespread hope, maybe even expectation for some, was perhaps November, Christmas relief.
And now?
Now, that's been pushed way out. McMenamin at Barrenjoey, for example, is now talking about the first cut maybe not happening until well into next year, sometime in the first half of 2026, possibly May.
May 2026. That's a huge shift.
Yeah.
That removes any hope of near-term relief.
It does, and it's not just delaying the first cut.
What else?
It also implies that rates probably won't fall as far or as fast as people previously thought, even once the cuts do start.
Well, why the extra caution?
Well, Kearns highlighted two main things. First, inflation, especially in those sticky services we talked about, is just proving stronger and more persistent than the models predicted.
Okay.
And second, because of that persistence, the RBA is going to be very cautious. They won't rush. They might not even cut rates every quarter once they start. They'll want to be absolutely sure inflation is behaving. Certainty over speed.
So the RBA having to sit tight, as they say, instead of cutting, that removes a tailwind for the economy. What does that actually mean for households waiting for relief?
It means the squeeze continues for longer. It definitely challenges any consumer bounce back because disposable incomes stay under pressure.
Right.
It could dent confidence generally, which affects spending decisions. And for many Australians, keeping rates high will likely challenge that rebound we saw starting in house prices earlier this year.
So it just prolongs the wait for that breathing room everyone needs.
Pretty much, yes. The waiting game is the main story now.
Absolutely. So for listeners wanting to follow this, what are the key dates? When do we get the next pieces of the puzzle?
Well, things move pretty quickly from here, actually. We've got the RBA's Monetary Policy Board meeting on Monday.
Okay.
Then, the really important one, Governor Michelle Bullock faces the media on Tuesday afternoon.
And that's the first big chance for her to publicly react to this 3% number, right? Give the RBA's official take.
Exactly. Now, let's be clear. Nobody expects a rate cut announcement next week. That's completely off the cards.
Right.
But everyone, economists, politicians, regular Australians, they'll be listening very carefully to her language. Any hints about how long they might stay on hold, what their current thinking is?
But the data point the RBA really trusts, the less volatile one, that's still a few weeks off.
That's right. The big test is the full inflation report for the entire September quarter.
And when does that land?
That's due out on October 29th.
Okay, so if that number, the comprehensive quarterly one, also comes in strong,
Then that cautious stance, that delayed timeline for rate relief, it just becomes even more locked in.
Okay, so let's just wrap this up. Bring it back to that core tension.
Yeah.
On one side, you've got the RBA view. They sort of expected a statistical bump because of those electricity subsidies ending. It was a known one-off factor, even if the timing was a bit surprising.
That's the blip argument.
But on the other side, you have that persistent strength in services, hairdressers, restaurants, rents not slowing down. That suggests deeper, stickier underlying pressures.
Homegrown pressures related to demand and maybe wages that the high rates haven't fully stamped out yet.
And it's that stickiness, isn't it, that seems to have really shifted the timeline for relief. Yeah. From maybe this year out to the middle of next year or even later.
It certainly looks that way. Which leads us to, I suppose, a final thought for you to consider.
Go on.
If the Reserve Bank genuinely feels it needs to keep interest rates at their current level until potentially mid-2026, that's nearly 2 years from now, just to keep inflation somewhere within that 2% to 3% target band, what does that really tell us about the Australian economy's underlying ability to grow, its fundamental capacity?
You mean its ability to grow without immediately sparking inflation?
Exactly. It really raises the question, is just achieving stability within the target range going to cost the average Australian consumer nearly 2 years of hoped-for relief? What's the price of that stability?